Welcome to the Melbourne Property Podcast, hosted by Sky and Lindsay Hammer from Convergence Buyers Agents, your local property experts.
This podcast is your go-to source for insights, trends and tips on navigating the ever-changing Melbourne property market.
Whether you're buying an investment property or your dream home, stay tuned for the next 30 minutes as we give you exclusive insights that will shape your next property purchase. Let's dive in. Hi, I'm Sky and welcome to another episode of the Melbourne Property Podcast. In today's episode, we're going to take a deep dive on Casey City Council. So it's a really interesting council here in Melbourne because it actually contains some of my favourite suburbs to invest in right now, but also some of the ones you should absolutely stay clear of and avoid at all costs. So it's going to be an interesting episode just to see the disparity between these suburbs. As always, I'm joined by my co-host Lindsay. Lindsay, how are you today?
I am pretty good, thank you. I'm looking forward to this episode because, like you said, there's just like one end of the spectrum and the other. So really interesting to see how you can get that all in one LGA.
Yeah, it's going to be a fun one to do a deep dive in. As always, we're going to run through the data. We're going to give you a little overview, hopefully so you feel like you know the suburbs a little bit more than just the data. Lindsay will probably take a lead on that and run through some of those suburbs for us. But as I said, we are actively buying some of these suburbs and other ones we're trying to avoid at all costs. So I'm looking forward to breaking down the numbers here today. As always, though, we're going to kick things off with a little thank you to our sponsor. This episode of the Melbourne Property Podcast is proudly brought to you by Scale Lending. Whether you're a seasoned investor looking to scale your portfolio or a growing family buying your next home, the team at Scale Lending takes the time to understand your strategy and structure your finances for long-term success. With access to over 40 lenders and a deep focus on property investment, they're not just ticking boxes, they're unlocking doors. So if you're ready to take that next step, visit scalelending.com.au, submit an inquiry, and someone from the team will get in touch. All right, as always, let's kick things off with what are we loving about Melbourne right now?
Well, I often talk about the variety of things on offer in Melbourne. And so right now I'm actually planning a hens party. It's for my cousin, so hopefully she's not listening to this because it's going to completely blow the surprise. But I'm organising a big busload of people to celebrate her hens party. We're going to go out and check out the wineries. We're going to do some flower crown making. It's going to be a lot of fun. So at the moment I'm sort of tossing up between the Yarra Valley and Mornington Peninsula. So for those that don't know the Melbourne area well, there's two really well-known wine regions that you have to choose from. The Yarra Valley I'm not as familiar with, but Mornington Peninsula, spend a lot of time down there because I live in the southeastern suburbs, so it's really accessible. You sort of got like your Pinot Noirs and Chardonnays there. Really lovely spots just to sit back, have a long lunch and enjoy. So if you have any recommendations for either location for hens parties, please send them my way.
Very good. Kind of a niche request this week, but we'll wait and see what happens. For me, it's actually the fact that people are starting to come alive again here in Melbourne. We've had some cold days, we've had some hot days, and I don't want to talk about the weather specifically, but there's definitely that feeling that the city's becoming alive again, particularly in the city, like midweek, Monday, Tuesday, Wednesday nights. That kind of enthusiasm to enjoy life again is definitely coming back. So for me, it's a kind of the return and the push into spring. We've got AFL final season just around the corner in September, and I think we're going to really see that noticeable pick up in Melbourne. It's probably the best time of the year to visit, to be honest.
Okay, so let's kick on. We're going to be talking about the city of Casey, so the local government area, LGA. It's located 40 kilometres southeast of Melbourne. It's actually Victoria's largest and fastest growing municipality, and it's a dominant growth area for the southeastern area of Melbourne. It's actually, would you believe this, the third fastest growing council in Australia. So that's behind Gold Coast and Brisbane City Council, which is pretty big. I didn't know that, to be honest.
Yeah, and like everyone knows about the southeast Queensland, that corridor which is obviously huge in terms of growing population. But yeah, to have Casey kind of slot in behind those, it would definitely be news to a lot of people.
The city of Casey has 5 distinct geographic regions. So it stretches from the foothills of the Dandenong Ranges right through to the coastal villages of Western Port Bay. The urban development is really concentrated in the northern parts though. The main industries include building construction, agriculture and building structure services. So a real focus there on the building industry.
Yeah, it is. And today there's obviously 29 suburbs in the Casey City Council. We're not going to run through all of those. It's actually going to be a shorter episode today because instead of going through all of them, we've essentially cherry-picked the ones that we really want to speak about. And that's because we get requested a lot or the ones we're buying in. And as I mentioned earlier, some of them are suburbs we are avoiding as well. But again, there should be a caveat to the front. I want to say this caveat up front. I've done a lot of content on some of these suburbs on social media, particularly from an investment perspective. And obviously investment is one thing, but there's also suburbs that people just want to live in because they want a brand new house and land package that just feels really nice to live in. And that's a completely different conversation to what we're kind of going to have today. And it's very much focused on investment. I've had some of my posts get hundreds and thousands of views, some great comments, some not so much. And so again, without being divisive, what we're going to do is talk about these suburbs purely from an investment play as opposed to maybe kind of where you want to live and where you want to raise a family. They are quite different metrics that we look at.
I think for some of them as well, I can sort of throw in that different perspective where I'm getting a lot of requests from owner-occupiers, and it's not somewhere we would recommend from an investment perspective. It's actually probably on the steer clear list, but I am still seeing those owner-occupiers increasingly inquiring about those suburbs.
Exactly. Yeah. So we'll try and cover off both as best we can.
Yeah. So we're going to run through Cranbourne West, Clyde North, Narre Warren, Botanic Ridge, Berwick, Hampton Park, and Lyndhurst.
Yeah, and there's a good spread both in terms of suburbs geographically, but also from a price point perspective, and we'll cover those off shortly. So anyway, that's enough talking. How about we crack in on and jump into the first one, which is Cranbourne West.
Yeah, Cranbourne West, located 40 kilometres southeast of the CBD. Also, no surprise, it's a really rapidly growing suburb. It's popular with families and first home buyers, lots of green spaces, close to amenities. It's sort of the newer part of Cranbourne. And when I say newer, I don't mean brand new, like new builds, sort of that 10 to 20 year mark. There's a nice little pocket near Ranfurly Golf Course. It's also close to the Cranbourne Royal Botanic Gardens. And you've got Quarters Primary School there, which is really well regarded. But it does depend on which part of Cranbourne West you're located in. So that's towards the more northern end near Lyndhurst. So definitely a really family-friendly suburb, all of those amenities on offer. We were there over the weekend for a couple of inspections, and I think it definitely feels like suburbia. It feels like a lot of the houses kind of look similar-sized blocks, lots of little cul-de-sacs and quiet streets.
Yeah, definitely. Yeah, very easy place to live, that's for sure. Yeah, it has a nice feel to it.
Yeah, exactly. I would say, though, that it's very car-centric. So in terms of public transport, you do have to go to Cranbourne if you want to catch the train into the city, and that takes about an hour. So most people seem to drive or catch the bus to Cranbourne.
Yeah, and the drive-in, like I've done it, actually did the drive-in from Cranbourne West this morning before we recorded this podcast, and we're close to the CBD here. No traffic. It's actually a really nice drive. Obviously, in peak hour, that would be obviously a bit heavier traffic, so just factor that in as well. But maybe we'll jump straight into the data. So from a data perspective, the typical house price now, and I know we speak about this a little bit, that when I say typical house price, I'm not referring to the median. This one's actually more adjusted, I guess, in more real time as opposed to the kind of 12-month median.
I would say it's a more useful price point, to be honest, because sometimes you talk about the median and it's just so far off from reality of what you're able to purchase a house for.
Exactly, yeah. So that typical house price is currently $741,000 in Cranbourne West. So again, for metropolitan Melbourne, still quite affordable, I would say. Typical rent around $530, $540 a week, giving us a yield of around 3.76%. So again, that 3.76 pretty typical for this area and this part of Melbourne. Having said that, I think only properties were bought there well over 4%. So again, don't think, I'm only going to get a 3 in front of my yield. 4.5% plus in some scenarios is still achievable. But again, you have to buy really well and also kind of look where that upside might be. It could be through a small renovation or something like that. But just want to flag that you can get higher than that 3.76.
I think a good example would be a property that we settled on today in Cranbourne West. So negotiated the price down to $515,000. That was for a 3-bedroom, 1-bathroom house on about, 450 square metres of land. And that's a house you're buying in Melbourne, $515,000. So there's definitely good deals out there.
Yeah.
Yep. And the rental yield on that one was closer to 5%. I think it was around 4.7 or so.
Exactly, yeah. And it needs a little bit of money. You spend on a bathroom, new carpets and that type of thing. Like, it's not a property you could buy on market. We bought this off market through an agent, which a house needed a bit of work. So it obviously didn't present well, but putting the right amount of money in and the effort and working with a great property manager to kind of make sure we ticked off minimum standards, this will be like a really good purchase for our client.
It's actually one as well, I think you can add a granny flat to the rear despite it being somewhat on the smaller size land.
Yeah, definitely. So it's only 450 square metres, and if you listen to our previous episode with Theo, the granny flat king, you'd also know that that's okay, and we can actually put a granny flat on there. So we're going to be talking kind of high single digits rental return for this one.
Yeah, so we're definitely buying in Cranbourne West for our investors.
Yeah. So if it isn't already obvious, that this is a suburb we're buying in for our clients. All right, some more numbers. Days on market sitting around 33, which again, we like to say that under 30, but again, it's no surprise. It's thereabouts. Vacancy rate, 2.84%. So again, generally we'd like to see that closer to 2 and below, which it is for a lot of locations. They're slightly higher at the moment at 2.84%. Stock on market, 0.26%. So again, like a lot of Melbourne, supply side is not the issue. Some suburbs are just lacking that demand. But again, this is not one of those either. Inventory levels, again, is 0.83 months. So basically, if no new listings become available all the current stock is going to be absorbed within less than a month, which is a really hot market.
I might go through some of the broader demographics for the suburb before we continue on. So in terms of the renter to owner ratio, 22% are renters, which is really what we like to see. So it's more swayed towards owner occupiers. The ERSAD score, so that socioeconomic advantage, is sitting at 4 out of 10, which is neutral. That's fairly good. And crime score is 12 out of 100. The population is just short of 20,000 people, and that's predominantly made up of people working in hospitals, aged care services, and supermarket and grocery stores.
I think we move on to our second suburb, and that is Clyde North. And this one is basically the suburb I was referring to before when I said it's hundreds of thousands of views on some of the content we've done on this. Lots of people buying here. And when I say lots of people, I'm mostly referring to first homeowners, interstate investors that don't know what they should be looking for a property. But this one, and I've spoken about it on the podcast before, it is ripe for developers giving property investment advisors or potentially some buyers agents huge kickbacks to buy in these suburbs. On the drive here, I was driving back from Cranbourne West. I had a phone call from an agent who had purchased a property off previously. He's now moved to one of these kind of companies. And within 3 seconds of the call, I was like, okay, he's going to try and flog off some of this stock to me and pay me $30,000, $40,000 to do so. So again, we obviously don't buy their stuff, but it's rampant throughout the industry at the moment. So again, we'll jump into the data and you'll soon see why we're not looking at places like Clyde North for property investment.
Just on that note, talking about developers flogging off stock and stuff, I think a key red flag for some people is if you're not paying for the service, then you are the product. So for example, if you have someone like who you think is your buyer's agent, but you're not paying them for their service, they're getting paid by someone. They're getting paid by the developer. So those margins have to feed into the end product and what the price is going to be.
Yeah, and you run me. I had a good conversation with someone once where saying like they'd gone to a broker and it was free. Like, so why should I pay for you as a buyer's agent? I said, well, firstly, the mortgage broker is being paid by the bank. That's where their funding's coming from. And they'd spoken to one of these kind of house and land providers, but they were called a property investment consultant. And in that, they said they had to pay a $500 like retainer engagement fee to kind of go to the next step. And then after that, it was like, oh, that's all you've got to pay. What they're not being disclosed, I'm sure it was tucked away in the paperwork somewhere, was that they're getting paid $30,000, $40,000 to basically sell this off to whoever will buy it. And we would make a lot more money if that's what we did ourselves. But ethically, I just think they're just horrible investments. So we just don't touch it. So it's a little caveat without going on my little rant, which I've done many times on many different platforms about places like Clyde North. Let's jump into the data.
Okay, so Clyde North, located 47 kilometres southeast of the CBD. It's probably known for, like you said, having lots of new builds, house and land packages and those sorts of things. It's, again, quite car-centric. On the public transport front, you have to drive or catch a bus to the Cranbourne train station, and it's about an hour into the city. So by no means, I guess, close, but definitely achievable in terms of commuting. Mm-hmm. This does mean, though, that traffic on Clyde Road is quite congested, and that seems to be a real pain point for local residents.
Yeah, and that's, again, all through these posts on social media we see in I guess, commentary is basically like, this was great 2 years ago when that kind of first suburb was set up. You maybe one of some of the first people to move in there, great. But then as these suburbs, particularly as they build out further and further, there's just more cars on the roads, more congestion. And when these kind of areas are going through the permit process and development applications, the developers obviously have to put some money into infrastructure. But then once they've done that, the developers in particular don't have any incentive to go out and add to that. And obviously the Victorian government isn't exactly flush with cash at the moment. So they're also not going out there just building new roads just for the fun of it. So again, getting there early, it might feel great. And then but over this kind of medium term, this is when you start to see issues. And we're seeing it out west as well, just through the lack of infrastructure spending.
In terms of population, we're looking at 31,000 people, and that renter to owner ratio is 23% renters. The ERSAD socioeconomic score is pretty good. It's sitting at 8 out of 10, so quite socially advantaged residents living in Clyde North, and the crime score is 14 out of 100. So at the moment, it's starting to look okay. It's ticking a lot of boxes, but why don't we delve into your side of the house, Sky, and talk about what the data looks like and why we don't like Clyde North?
Exactly, and everything you said there kind of speaks to why that, I guess, for an owner-occupier, this suburb starts to make a bit more sense. But from an investment perspective, we're talking about a house price around $863, so typical house price $863,000, a typical rent around $540 a week, yield around 3.26%. So again, we're starting to really get down into those lower kind of yields. Days on market. So now this is when we're starting to talk from an investment point of view. Days on market's currently at 50. And the issue what we're seeing is that short-term slope's actually increasing. So that days on market is not coming down from 50, it's actually going up. So
and quite drastically as well.
Yeah, particularly I think there must have been another release of properties somewhat recently because we're seeing more availability both from a opportunity to buy perspective, so the stock that's currently on market, but also from the vacancy side. So days on market at 50 can be scary. If it's coming down, we don't hate that, but it's going up, which is the bad thing. But the vacancy rate is at 5.47%.
Wow.
We're talking with all the suburbs we've talked about usually, like the ones we are actively buying in, we're sub 2%, sub 1% in some instances. The country's going through a rental crisis, yet basically 1 in 20 properties is currently available for rent in somewhere like Clyde North. If you're an investor, and then the other thing, and this is without getting off track again, lots of developers are basically saying we'll give you a 1 year, 2 year rental guarantee. So for conservative investors, first-time investors, that it's really appealing that someone's going to say you can buy property, you don't have to get tenants in for 2 years and they're still going to pay you rent. That sounds safe, but to me that's like a huge red flag. Like the fact that it's going to take like potentially 3, 4, 5 months to get someone into that property means there's just too much supply in the rental market. I just would not be touching that suburb. But again, we're seeing people get trapped because it sounds safe when in fact it's complete opposite. On supply side, we're seeing that inventory level around 1.63 months, which again is probably a bit twice as high as Cranbourne West, but relatively that's actually not that bad considering. But it's the building approvals. So lots of markets we're talking sub 1% or basically zero building approvals. Here it's at 4.49%. So it's not just about the supply in the market right now. It's the fact that these building approvals are squared away and there's more supply coming to the market in the form of more house and land packages that look exactly the same, different colour front doors, as I've said before, but generally speaking, large houses on smallish blocks. So again, we want to see that big land component when in actual fact we're just paying for a bigger house.
Is there a lot of vacant land around Clyde North?
There is, and it's not just Clyde North. I'd say Clyde is very similar in this perspective. But again, you kind of you zoom out in Google Maps and you see there's plenty of land. Not all of that is developable, but there is still plenty of supply still to come. And I think if there is a good place to look at it, Tarnee out west, which is another suburb we've spoken about in the same kind of way before. If you just look at Google Maps, put it on satellite imagery, see how much kind of dirt's been turned over and where that supply is going, you'll see that there's no shortage of new houses coming.
I think a lot of people talk about the depreciation benefits of buying a new house. What do you think about that, Sky?
Again, it's another trap, and this is another one that we see, particularly if a person helping you buy property, let's call them property investment consultant X, can give you like a 20-page fancy glossy brochure of like all the benefits about infrastructure spending, depreciation benefits. The thing that's always missing is that depreciation benefits are great for holding that property. Let's say over the 1 to 5 year, even 1 to 10 year, you'll get $10,000, $20,000 back a year in tax benefits. What they don't mention is that's all claw back at the end. So when you go and sell the property, they're all claw back. So it's great for holding, but they're not really a benefit when you kind of factor in that when you sell the property, that's all clawed back as well. So please look into that more. I was going to say speak to your accountant or financial planner. Problem being, and this is another a warning, a lot of them are actually the ones flogging off this stock to their clients. Mortgage brokers, accountants, financial planners. We've actually seen them as the ones that are recommending this to clients, and they're getting paid by the developer that 30, 40K. So again, keep that in mind. If it comes through anyone, if it's not an established house, ask if they're getting a payment because a lot of the time they are.
One thing to note as well for Clyde North is that hold period is really quite low. It's at 5.73 years. So people aren't even holding it long enough to get a lot of those depreciation benefits.
And I get DMs, I get messages, we get emails of people like saying, I wish I heard this podcast, I wish I heard you talk about this before because what's happening. And there's another suburb, Rockbank, kind of out northwest of Melbourne. It's happening the same out there. You've got Wallet to the north. People are buying there and they're living there for 1 or 2, sometimes let's call it up to 5 years. And they're saying, I can't live here. The infrastructure spending hasn't happened that was promised. It takes me 2 hours to drive to work. If there's one crash, basically the whole suburb shuts down. And so they're selling. And that's why that whole period is so low compared to the rest of Melbourne, compared to every other suburb in Australia. It's because people are looking to get out of there once they moved in. And we've also got investors doing the same thing, where they've got these high vacancy rates and they're actually selling out after a few years when they may be intended to hold the property for 20 plus years.
Potentially selling when the developer's rent back guarantee runs out.
Exactly right. Yeah. They're not doing 10-year rent back guarantees, that's for sure.
All right, let's move on to suburb number 3. We're going to be talking about Narre Warren. So 40 kilometres southeast of Melbourne CBD, quite a family-friendly suburb. There's plenty of greenery. You've got Kroll Park there. It's a mix of residential housing, so from your modern estates right through to established homes. And it's mostly all freestanding houses. So 91% of the dwellings in Narre Warren are freestanding houses, so not a lot of units or apartments. You sort of get bigger blocks there and close to the Dandenong ranges. So a lot of people like that accessibility there. It's also home to the bustling Westfield Fountain Gate. It's actually one of Australia's largest shopping centres. So great on that amenities front. The crime rate, though, for Narre Warren is quite high. So that's sitting at 20 out of 100. Definitely a consideration for owner-occupiers there. In terms of transport links, Narre Warren has great transport links. So you've got the Narre Warren train station and there's several major freeways, so pretty good access into the city. It is a little bit further out, so does take a while though.
Obviously, for longer-term listeners, we'll know that Lindsay usually pulls together the summaries of the suburbs and I'm focused on the data, but I think you've missed a major key point about Narre Warren, which you've left off the list here. Birthplace and home of Kath and Kim.
Really?
Yeah.
There you go. Yeah,
I think you missed
missed
that one
that
up there. If you're from Melbourne, it's probably not the first thing you think of, but I know a lot of people maybe interstate that were big Kath and Kim fans. Anyway, let's jump into the data. So typical house price here for Narre Warren, like $903,000. So again, we're starting to get up there in price. That rent though is around that $510,000, $520,000. So it's actually quite a bit lower and it's dropping us at the rental yield into that 2.95 range. Again, it's not exactly what we want from a rental yield perspective. Days on market, though, at 25. So that's coming down. That's positive. That's what we want to see. And the vacancy rate at 2.53%. So again, not too bad, not too good. A little bit in between. So again, from that perspective, it's okay. On the supply side, this is where it gets interesting. So 0.31% stock on market. So
not a lot.
Basically no properties available for sale. I saw, I think it was a reel or a TikTok or something on it this week where there's just 30, 40 people at auctions. So again, Narre Warren, particularly for that first homeowner or potentially even downsizer, really strong market at the moment with that lack of supply. Inventory levels, 1.07 months. So again, basically no inventory available to purchase, and that building approvals is just 0.11%. So we're not talking 4s and 5s like some of the other suburbs we've spoken about. There's basically no new stock coming to the market.
In terms of demographics, it's a population of around 27,000 and 28% of those are renters. So pretty much in the sweet spot in terms of predominantly being owner-occupied. ERSAD score is 4 out of 10, again, fairly neutral. Crime score is a little bit higher at 20 out of 100. I mentioned that earlier. I am getting a lot of requests, though, from owner-occupiers looking to buy in Narre Warren. I think it's a good mix of those family-friendly amenities, but also that affordability. So with the typical price point of around $900,000, that's still considered somewhat affordable if it's your principal place of residence.
Yeah, and I'd say like historically it hasn't been like a strong owner-occupier appeal for people looking to use a buyer's agent or buyer's advocate to get into it. But I think based on those supply numbers, that's where we've seen that inquiry really pick up in these suburbs because there's just no stock available. As I mentioned, that people going to auctions, there's just so many people missing out every week that I think people are starting to turn to advocates and buyer's agents a bit more, which I guess help to get them into the market.
Absolutely. Shall we move on to suburb number 4, Botanic Ridge?
Sounds good. Do you want to kick things off with a little overview?
All right. So we're a little bit further out now. So we're 54 kilometres southeast of the CBD, known for having lots of green spaces, very suburban area. It's actually a very small suburb and it's bordering the Cranbourne Botanic Gardens. So as you can imagine, a lot of that greenery there. Mostly houses. So 96% of the dwellings there are freestanding houses. Again, not many apartments in the suburb. In terms of transport, again, Botanic Ridge doesn't have its own train station. You have to go to Cranbourne to then catch a train if you're commuting into the city. It's a very small suburb, so it's only 6 kilometres squared and a population of about 6,500 people, so quite small. 12% are renters, so very, very heavily owner-occupier dominated and a very high ERSAD score of 9 out of 10. Very low crime score of 10 out of 100.
From the typical house price, we're now at that $921,000. So again, not by no means affordable anymore, despite it being 50 odd kilometres out from the CBD. Typical rent around $580 a week, so that yields at 3.29%. From the demand side, I guess we look at it from two ways, buying and renting. So days on market's at 42. So again, not too bad. It is rising though, so it's going the opposite direction to what we want to see. And the vacancy rate's at 3.28%. So despite it being owner-occupied dominant, not many investors in the market, the vacancy rate's still fairly high. So that's, a cause for concern as well.
What about on the supply side?
Supply side, we're talking like most sub $1.5 million places in Melbourne right now, supply is still really tight. So stock on market at 0.47%, inventory levels at 1.22%, and the building approvals are at 2.44%. So slightly higher than some of the other suburbs. It's about 60, 70 approvals. So again, there is some more supply coming into this market.
What are your main concerns then when investing in Botanic Ridge?
Look, for me, it's just that the numbers don't make sense. So like we're talking close to $1 million for a purchase price. We're talking 3-ish% yield. You've got rising building approvals, so more supply coming to the market. And although there's limited supply right now, it still doesn't make sense when you compare it to some of the other suburbs we've spoken about, like Cranbourne West, where you get in at a more affordable price point, a better rental yield, stocks falling, days on market's falling. That's the type of market you're going to get better growth in, both short and medium term. Botanic Ridge, I think there's just so many better options out there.
Moving on to suburb number 5, Berwick. 41 kilometres southeast of the CBD. Now, I have heard Berwick referred to as the Toorak of the East. What do you think about that, Sky?
No comment.
No comment.
Yeah, I mean, it is not. If I was to live out that way, it's probably the pick I would choose, to be honest. But I've never heard it called the Toorak of the East. But anyway, there you go.
Well, I have.
Okay.
It's quite like historic. You've got that historic charm there. It's sort of tree-lined streets with some heritage homes, manicured buildings, those sorts of things, particularly down the main street, those older homes that have been around basically since the 1800s. It was previously its own sort of country town that's just, Melbourne has expanded and it's now become a suburb, I guess. Really good top-notch schools though. So again, that sort of family-friendly appeal with all the manicured lawns and whatnot. But in terms of schools, we've got Berwick Primary, Berwick Secondary, St Margaret's, and also Haileybury has a campus in Berwick too. Close enough to the Westfield, the Fountain Gate Shopping Centre, so you've got amenities right at your doorstep as well.
In terms of house price now, we're getting over the $1 million mark. So typical house price is $1.05 million, up around 1% over the last 12 months. We haven't kind of mentioned that figure for most, but they're all in that kind of slightly increasing or slightly decreasing, much like the rest of the Melbourne market. Its typical rent though is at $550 a week. So again, We're a fair way out. Typical house price is higher because there is those kind of older, nicer style homes, not the cookie cutter ones. So that yield drops down to 2.7%. So again, and I caveated this at the start of the episode that it's not an location I'm talking about from an investment perspective, but you can definitely see why from an owner-occupier perspective. There's probably plenty of interest in buying here.
Yeah, in terms of the demographics, so it's got a really high ERSAD score. No surprise there though. It's 9 out of 10. Low crime score of 11 out of 100. It's quite a large area, so a population of around 50,000 people and 33 square kilometres in terms of the actual size of the suburb. There is a train station there, so you've got Berwick Railway and also you can get onto the Monash Freeway pretty easily to get into the CBD. In terms of that, because it's such a large suburb, in terms of what that suburb looks like, the north side is the older side, so still has sort of that historic charm. And then the south side of Berwick is where all the newer estates are, but it's still pretty well laid out, so probably doesn't feel quite as cookie cutter as places like Clyde North. The main downside seems to be Clyde Road with some of the congestion there and then sort of like teenage hoons and that, which we are seeing increasingly a lot of residents across Melbourne complaining about, so that's not unique to Berwick either.
In terms of demand, so that's the days on market numbers actually at 31, so it's quite low. It is increasing slightly, but nothing too concerning, so I have no issues there. Again, the vacancy rate though, 4.12%. There's a lot of these pockets, particularly in and around Casey City Council, that number is a lot higher than you'd want to see. So for us, again, from an investment point of view, not something we're touching, but you can probably see the appeal from owner occupier. Supply side, again, that's completely fine. Stock on market, 0.3%. Inventory levels bang on 1 month, and building approvals are pretty low at 0.65%. So not too concerned from a supply side. It's more that vacancy rate and the lower yields that really put me off from investing here.
Suburb number 6, we're going to be talking about Hampton Park, located 36 kilometres southeast of the Melbourne CBD. It's sort of known for having a more lower socioeconomic population. It's a very affordable suburb, but these days I would say it's really quite a family-friendly area and it's away from that hustle and bustle of Narre Warren and the Dandenong suburbs. In terms of population, it's about 26,000 people at the moment living in Hampton Park. 29% of those are renters, so still predominantly owner-occupiers. The ERSAD score, which is that socioeconomic score, is 2 out of 10, so definitely on the lower end. And the crime score is 13 out of 100, which is good. As we've spoken about a lot, though, those lower socioeconomic areas are not necessarily areas that we stray away from. There is no correlation between crime rates and capital growth. Gentrification is great, particularly at those affordable price points where, we're getting that capital growth. So it's not something that means we're going to stay away.
Exactly, yeah. And we've spoken about on other episodes about Frankston North and those types of pockets that definitely have a higher crime score, but are going to be the front runners in terms of capital growth over the next few years. So again, it's not a reflection of the suburb based on crime, but it's more, I guess, the broader data points. So typical house price for Hampton Park right now is $711,000. It's up around 2.5% over the last 12 months, so that's fine. It's actually kind of quite good for Melbourne in some respect. The rent return per week is at $498. So again, we're now under $500 a week, which is the first one on this list to do so. So it gives us a rental yield of about 3.63%. So it's a bit more, I guess, a healthier yield. But as you'll see in a second, it's still not exactly a suburb we're jumping into. But to be honest, it's probably one of the better ones that we're going to cover off today, but definitely not someone we're buying right now. So
I am getting increasingly requests from owner-occupiers looking to buy, and I think it's due to that affordability factor. Yeah. Like first home buyers looking for their first home, they want a house, a bit of space, not looking for an apartment. These are the areas that first home buyers are looking in. Exactly,
yeah. And we've seen this in a few other suburbs as well, which is due to affordability, due to high interest rates, serviceability, borrowing capacity, all of that kind of stuff. These are the types of suburbs that people are definitely buying into now. So from the data perspective, I guess just to close this one out, days on market 32, which again, quite competitive, no concerns there. Vacancy rate at 2.89%. So again, it's slightly higher than what we'd like to see, but again, it's kind of sub 3%, which is positive. Stock on market 0.37%, inventory levels 1.19 months, and the building approvals, because it is a bit more of an established suburb, is just 0.13. So again, it's not 4 or 5% like some other suburbs in the KC City Council. It's actually on the better side. So for us, is Hampton Park somewhere we're buying right now for clients? No. Does it look okay? Yes. So again, it's somewhere we'll keep an eye on. It's not high on our list right now, but I can see the appeal to it with that kind of slightly higher rental yield, I guess affordable entry price, but I think it's going to be very driven by, owner occupiers for a little while yet.
Okay, and finally, we're talking about Lyndhurst. So final suburb for this list, 36 kilometres southeast of the CBD. It's quite a small suburb, so a population of just short of 9,000 people, and the size is around 9 square kilometres. It's sort of bordered by Sandhurst and Lynbrook, and again, very family-friendly, owner-occupier dominated. 95% of dwellings in Lyndhurst are freestanding houses. There's, again, not a lot of apartments. 22% are renters, so predominantly owner-occupiers. That's 78% owner-occupied.
Yeah, in terms of price points, we're talking now the typical house price around $920,000. So again, we're getting up there. The rental yield is around 3.45%. So again, a bit lower than what I'd want to see, to be honest, but at that price point, fairly reasonable. We've seen that quite a bit. Inventory level is at 1.22. So again, that's fine. We've got no concerns there from the supply side. But days on market's up around 39. So 39, a little bit higher than what we want to see. I actually quite like Lyndhurst. Again, it's kind of like Hampton Park in the sense that there's still lots of own-occupier interest. So although the data doesn't look amazing right now, you can see a time where it could pivot to being quite a good suburb very quickly. And talking in the next few months, and it could be a suburb that we start buying in as well for clients, for our investor clients. Lyndhurst definitely on our list for owner-occupier clients. Right now, investors are not so much, but we'll wait and see.
Yeah, I can see the owner-occupier appeal. There's some great schools there. It's got a really low crime score of 10 out of 100. The ERSAD score is really high, 9 out of 10. So you can definitely see that appeal there. And as I said, it's bordered by suburbs like Sandhurst. So all the suburbs we've been talking about in the Frankston LGA are right there at its doorstep. We're now talking about the city of Casey. We've got Cranbourne West really close by. So definitely see the appeal there in that location.
One thing to consider though with Lyndhurst is that the vacancy rate is quite high. So it's sitting around 5%, and it's one of the reasons why we're not buying there for investors. So if you are doing a due diligence on this suburb, just keep that in mind because it doesn't tick all our boxes from an investment perspective right now.
Well, that's all we're going to talk about today for our deep dive on the city of Casey. So as I mentioned, we weren't going to go through all 29 suburbs on the list. So just a little teaser there with some of the best, some of the worst, and some of the in-betweens.
Exactly. Yeah. And for us, we're definitely buying there for our clients right now, particularly from the own occupier side. There's lots of appeal there. True to affordability, but just like that nice kind of suburban feel. It's very, I'd say, very typical Melbourne, I think, in some respects. So quite like it from that perspective. But for our investor clients, particularly places like Cranbourne West, and without wanting to heat up the market anymore, it's probably my pick of the bunch for suburbs to investing in there.
Very good.
All right, thanks to everyone for listening to another episode of the Melbourne Property Podcast. If you want to hear more about what we offer our clients, feel free to go check out our website. We'd love to help you with your next purchase in Melbourne. For those that want to know more and maybe check out some previous episodes, feel free to give us a follow, give us a rating on Spotify, Apple Podcasts, wherever you listen to your podcast. Otherwise, look forward to talking to you again soon. That's a wrap for this episode of the Melbourne Property Podcast. Just a reminder that this information is general in nature and should not be considered financial advice. If you'd like to discuss your personal situation, book a discovery call with the team at Convergence Buyers Agents. Our link is in the show notes.
If you learned something from this podcast, hit subscribe and never miss your fortnightly dose of Melbourne property insights. Catch you next time, and happy house hunting.